Okay, good morning everyone and welcome to the Manchester Digital Fintech Forum. We've had gremlins this morning, so we just have a speaker logging back in and unfortunately you won't be able to see Alison this morning. So for those of you who don't know me, I'm Katie Gallagher. I'm the Managing Director of Manchester Digital. And just before I talk to you about the topics for today, I just want to say a huge thank you to our forum sponsors, Teledata, a Manchester born and bred data centre and cloud hosting company who work with a lot of the region's fintechs, and also And Digital, who have several offices across the UK, a big presence in Manchester, and help companies with accelerating their digital capabilities. It's also safe to say that And Digital have a lot of experience of working with fintechs and have also been invaluable to Manchester Digital in helping to develop and shape this series of forums. So I will just hand over to David quickly for a couple of minutes to tell you a little bit more about what they do.
Thank you very much. So I'm going to say very little on that. Exactly what you said. We are a digital services company all over the country. Manchester office, we work with a number of clients in the Manchester area, and we kind of accelerate digital delivery, and we do that really by doing two things. So one, by building kind of really great quality products, but second, by making sure that we build capability in our client organizations as well.
Okay, thank you. And today we are also joined by Mark Hartley, who is the founding partner and CEO of Bankify, and Alison Fairclough, the head of IT change office at Handelsbanken. If Alison, you could just tell us a bit about Handelsbanken and what you do there.
Of course. Morning, everybody. Apologies for the camera situation today. So I'm head of IT change office at Handelsbanken UK. We're a Swedish bank. We've got over 200 branches in the UK now. We're a local relationship bank with sustainable values.
Okay, Mark. Has Mark frozen again? Yes, it's frozen. Okay, well, we will press on and hopefully Mark will be able to tell us a bit more about Bankify as we go through the panel discussion. So the way that today will work is obviously we're gonna chat through some kind of very relevant topics and issues that are happening in fintech. If you can pop any questions in the chat box, I will pick them up as we go along and field them to our speakers. If there's any questions at the end, we will sweep those up and make sure that we answer any burning queries. And then after the end of the session, there will be some networking, which you can access by clicking the icon on the left of your screen. So today we're going to look at how fintechs across the board have responded to the constantly shifting landscape. We're going to look at changes in consumer behaviour and tech solutions that are bridging gaps in education, money management and money inclusivity. We're going to look at online versus offline models. We're going to look at reduced spending and other changing behaviours. And we're going to look a little bit, if we've got time at the end, at young people, digital spending and education. So I think it's safe to say that 2020 has challenged everybody. But in terms of financial services, I'm interested in what the panel think the major challenges have been for fintechs versus more traditional banks and how they're managing their omnichannel offerings. Alison, can I come to you first on that? And could you give us the Handelsbanken view and experience?
Yes, of course. I come at this as the more traditional bank, of course. So Handelsbanken is, as mentioned before, a local relationship bank. We've got over 200 branches in the UK, which might surprise people. We're also decentralised, and the decentralised model means our branches are empowered to make local decisions. And the branches are almost like the hubs of the community, so they're very important for our customers and the local communities within which the branches are based. And the reason I tell you this, and the reason that short backstory there is quite important, is because we are very much into human interaction, and we're very much about the personal touch. So if you were to remove the bank from the situation and that personal touch, we essentially lose some of our identity. And I think that's been a big challenge for us this year. So the world has changed. So our customers haven't been able to use and interact with the branches the way they have in the past. And so we've had to be a little bit more adaptable with our communication styles, and or not so much styles, but more the communication medium we use. And yes, we've had to adapt, and we've had to make a lot of changes there, because our customers have had to use technology, whereas in the past they've been able to come into the branch and been able to talk to somebody face to face. So yeah, a lot of challenge for us, I think, this year. And what I would say is it's not just the front line, so not just from a customer point of view, but also from an operational point of view, where our staff have been used to being in the same physical space, being around each other, and haven't been able to do that this year. So we've again had to rely on all the technologies such as Skype, Microsoft Teams and Zoom, etc.
And do you think you've been able to translate your culture from the online in-person experience across to the online, did I say online twice? I meant offline,
Yeah.
to the online experience?
It's been really quite tricky. And I think, again, I just really need to reiterate the human interaction and the personal touch is a part of our culture. And I think what's worked better than we thought it may have done is the virtual meeting places. So even though our customers haven't been able to get into the branches as they would like to, we have been able to use that new technology such as Skype largely, but also we're able to interact with Zoom and Microsoft Teams. So the culture in itself hasn't been too impacted, because we've still got that face-to-face interaction, albeit it's virtually and not in person. So there's a difference, but I think we've still kept the culture strong. And I think it's that ability to get into the branch and talk to a person that our customers know, and our branch advisors and managers know everything about our customers and their financial situation, and having that friendly face and that knowledgeable person at the end of whatever medium it is has been really important in keeping that culture strong. I think from a more that's the front line, but from a more operational point of view, I think we've had, again, as I said before, we're used to being in the same physical space. We're used to seeing each other. We're used to interacting with each other in person. So we've had some challenges there, but we've made the best of it. And actually, one of my colleagues said something really interesting to me the other day, or a couple of weeks ago, I should say. And he actually said to me he'd had more interaction with his project stakeholders, more so than before the pandemic even hit. So that was quite interesting. So we are being adaptable, and we are being able to make the best of the situation without diluting the culture too much.
Okay, that's great. And David, just coming across to you, how do you think some of this, as people are paying closer attention to their money and they've had more time at home to think about their life admin, should we say, how do you think this is affecting consumer behaviour? And do you think people are going to remain loyal to their traditional banks? And is there shifts with certain demographics?
Cool. Yeah. So I, just playing a little bit off the back of Alison's response there, I think some of the challenges from a customer base, first off, as we've moved into kind of COVID situation, is there's definitely been, I guess, a barrier for digital first to some extent. So people needing more specialist support. So things around payment holidays and everything else, and just circumstances that they don't quite fully understand. So making sure that you've got a stronger omni-channel type offering, I suppose, is the right term. So that you can kind of do things online, you can interact the way you want to, but then when you need to reach out for the kind of human interaction, human touch, that you can kind of do that and speak and contact a specialist. So I think there's been some really great examples of that happening. And many traditional, I guess we use that word since we started it, kind of traditional banks, they've really responded to that at the same time as, I say, standing up new products, changing their organisation to be more kind of back office and decentralised and kind of remote as well. So how to do that? So yeah, I think when we look at that kind of question, there's an element of the customer offering and how that's changed, as well as an aspect of team culture and that's folks. We helped quite a few clients at the start, kind of late March, April time, thinking about pivoting their teams, and very much the focus was on kind of number one, for their teams to become remote and to be able to work effectively, which, the number of challenges that in terms of scaling their IT infrastructure, and being able to just communicate. And then the second one was, as that's gone on a little bit longer, being able to make sure that a remote way of working doesn't impact the kind of organization's culture too much. So where you've had a kind of traditional, mostly face-to-face type team, that you've been able to bridge the cultural gap of people being remote 5 days a week for months on end as well. So yeah. You asked me about changing consumer behaviour as well, didn't you? There, so let's come in on that. So I think there's various aspects of consumer behaviour that have changed over time, and we're at a bit of a crunch point in terms of really seeing that as well. So I'm gonna try and list some things out. So number one, I think the first one has been around things like payments and making less of them. I think people are spending less, data suggests people are spending less money, less transactions, but also doing that in a potentially different way. The whole thing about credit and the kind of loan situations throughout furlough. So again, people have been taking less credit, but also deferring payments. And I think quite a few of the payment holidays will starting to come to that kind of crunch point where they're ending at the end of October. Same with the furlough scheme, where people have perhaps had a shored up income, due to kind of end shortly. So actually, there's a few things that are driving a change of behaviour and a future change of position as well. So being able to continue to pay your commitments out and do that effectively. I think the other one is people are more cautious, I'd say, at the minute. So not spending unnecessarily, making, booking a holiday, for example, is one of those things that, because it's complex, it's not just about the money, because it's complex and you don't know what the landscape will look like in a few months' time or middle of summer next year even. It's very difficult for people to kind of make those commitments, so aren't, and therefore you've got kind of like turnover reductions as well. I think that creates a really challenging landscape for not just the economy, but financial services institutions of all shapes and sizes, really. You've got low interest rates as well at the moment, so very difficult kind of trading conditions if you've got doubts over bad debt and doubts over future consumer traffic as well. So lending, transactions, everything that traditionally drives revenue. Okay, thank you. We've got Mark back, hopefully for a while. Mark, could you David's led us brilliantly onto a question for you, but just before we do that, could you just tell us a bit about yourself and Bankify, please?
Well, hopefully you can hear me. Can you hear me all right?
We can hear you, we just can't see you.
Well, that's possibly not a bad thing for the audience, that is. Morning, everybody. Apologies for being late. Embarrassing issue for a technology company with technical challenges. I'm the founder and CEO of a company called Bankify. We are described as a fintech, although we do not disrupt and challenge financial institutions we actually aim to help financial institutions move into a world where they're competing with fintechs and other traditional financial institutions. So we specialise in the provision of business banking services to the traditional banks to help them compete with fintechs and other organisations. Prior to setting up Bankify, I was a founder of a business called Clear2Pay, which provided payment processing services to banks all over the world. And I've also sat on the advisory board to the Nationwide Building Society and Nordea, which is the largest Scandinavian bank, advising them on payments and open banking and regulatory changes. And I've completely forgotten what you asked me, Katie.
No, I haven't got that far yet. I thought we'd do the introduction first. So I think David had kind of alluded to, the fact that things are really tough for fintechs in terms of, various people not taking out credit, low interest rates, etc., etc. So we know that fintechs across the board have had to change their offerings to respond to the pandemic. Some government driven and for various other reasons. So government asked banks to offer the business interruption loans and the bounce back loans. And obviously, normally in the before times, launching these kind of products on such a massive scale would take a while for companies to get them to market and get through all the various barriers that they had to. But it was probably a record-breaking time of getting those products to market. So, what impact has that had on banks in terms of managing the product releases and getting that stuff shipped out? I'm happy for anyone to take that first.
Should I answer that, Katie?
Yeah.
So from a Handelsbanken point of view, so that is a product we've been able to offer. But I think it's fair to say that the Handelsbanken has definitely felt the strain of having to offer a brand new product in such a very short space of time. And although it was something we have been able to offer, I should also say our branches take an awful lot of pride in the bespoke products and services that we offer. And because we are that decentralized bank, those products and services are there to suit the needs of our customers and their financial situation. And that was the case before coronavirus and is the case now and will be the case after coronavirus. So, and what we also know is one size doesn't fit all. So that was the challenge with the bounce back, with the I beg your pardon, the CBIL business interruption loan. We have learned some things from it, though. I think it's fair to say we have seen that we can be very collaborative, and when the chips are down, we can deliver products really quickly, and we can be very adaptable, as I said earlier, and we can make use of the technologies, even if we can't be face to face as we would like to be. And also, it's shown us that actually we can also be quite cross-functional, excuse me, quite cross-functional and also quite autonomous in the way that we deliver change. And I think that's something that we're going to be able to build on. And we are a bank of, immense social responsibility. And I think right now in the current climate, I think that's something that we're actually taken to an even greater extent, and we're taking our social responsibility even more seriously through being able to provide these products, which are, providing a bit of a lifeline to our customers at the moment. So I guess, so we've learned a lot of lessons through having to deliver things really quickly in a more agile way, but also in a more bespoke way than in a very bespoke way that meets our customers' needs.
And how did you, in terms of that agile way, did you have to do any kind of like short-term recruitment, or how did you manage to kind of build that bit of work into your business?
Yeah, so it's really a good, interesting question. So we are trying to be more agile anyway, I think, as most organisations are. We are trying to build and deliver products that are more value add to our customers in a more efficient way anyway. So, and I think what this allowed us to do is try some of those new ways of working and actually, see if we could make it work for us and we could deliver. And I think we've had a lot of successes, but we've also had a lot of challenges as well. And again, I think in terms of building that into our more BAU, business as usual, I think we'll leverage the positives, such as being able to interact and work remotely better. We're probably working different shifts and possibly longer hours, more creative hours. And so actually we've been really quite productive working remotely and working in different technologies. So I think there's been a little bit of a mindset shift, I think, in that we don't always have to be in the office from a 9 to 5 point of view. We can actually work in a more agile way and be more productive with it. So we'll build on that going forwards, I think. Great,
thank you. Mark, the CBILS and the bounce back loans have come under a bit of criticism for potentially being quite open to fraud, and what will the long-term impacts of that lending be? What will they be for us as taxpayers? Can you kind of talk us through what you think what's gonna happen?
Yeah, sure. I think first of all, they were obviously required, and the government had to respond in some way, shape, or form to plug the holes and the gaps that were caused by this kind of unprecedented set of circumstances we find upon ourselves. And I think when they were originally implemented, you'll probably recall that the government were covering 80% of the first loss position, which meant the banks were still effectively going through a normal lending process where they assessed risk and the ability of the business to pay back. And there was a major outcry around that, and that ultimately caused the government to step in and cover 100% of the loss position. So effectively, the banks are taking zero risk on any of the loans that have been given to the business community. Now, that in itself creates a major problem, because I think what we've created, and again, perhaps for all very good reasons, but we've created a major problem in terms of a huge amount of debt that is growing, and the vast majority of which may never be repaid. And that obviously has consequences for everybody, most notably the taxpayer, because it's not the banks that are going to fit the bill for this. It's going to be the taxpayer. So there's a major impending scenario where we could see just a load of defaults, businesses going to the wall, and none of that money being recovered. And actually, that in itself highlights another major problem. So even the businesses that can survive and are in a position to pay their loans back, we also have a much bigger problem, in my opinion, which was a problem even prior to COVID, which is around businesses collecting money from customers, whether those customers be consumers or other businesses. So we have a massive problem around late payments collection in the UK, and actually predominantly all over the Western world, actually. So in the UK, the average late payments for a business that has invoicing terms of 30 days, they typically don't get their money for 56 days prior to the crisis. And now, since COVID came in, that late payments issue has gone up to 71 days. So that means that small businesses, micro businesses, which are the lifeblood of the UK economy. So there are 4.5 million micro businesses in the UK, and a micro business is described as a business that has 0 to 10 employees. So they are the backbone of the British economy. They employ 60% of all private workers and make up 99% of all private business. And they're waiting 71 days to receive their money, often from government departments or other bigger businesses. So they're wearing the cash flow of much larger businesses. and they're the ones that have been taking out bibbles and sibbles. And as David rightly pointed out, the holiday comes to an end at certain points in time, and they're going to have to start servicing that debt, and they're going to have to start paying that debt down, repaying the interest on the capital. And if their customers aren't paying them, how are they going to do that? So we've got this kind of potential storm where we've got businesses that have taken out debt, they're not able to collect money from their customers, and therefore you see the 4.5 million micro businesses be radically reduced, because unfortunately a significant proportion of them could go to the wall. So, you know, the debt scenario where the government thought they were doing the right thing was to push debt on people, when in actual fact what they really need to do is solve the late payment crisis and actually force people to pay their dues on time, and actually that would have prevented the necessity of organisations taking out debt in the first place.
Okay, so David, how do you think we begin to tackle that late payment problem? Is there a tech solution, or is it, or, you know, there's obviously needs to be some legislation behind it, but what do you think would help ease that issue?
Yeah, so I think there's probably a couple of things. So one, in terms of just going back to this, the sibbles and bibbles and those types of things. Mark was talking about the kind of collective government and therefore kind of people debt of that. Kind of read some estimates somewhere that basically looking at between 15 billion and 34 billion, so quite a wide range of impact of kind of bad debt against those loans. I think the other part of it is the collection of those loans. So again, you know, those products were needed, you know, and put in place kind of responsively, a fairly kind of short notice. But then you've got issues around collection as well. So again, I don't believe there's a method for collecting those that's been agreed yet. And again, that's maybe one of those areas where more adaptable and flexible kind of fintech partners could help, should I say. So you know, there's definitely kind of gaps in that model and how those especially defaults on those loans will be enforced and collected. Yeah, the overall payment crisis, that's you know, pretty tough position. I think most of it, or a lot of it, is kind of links to kind of cash flow within businesses. There's been quite a lot of work that I've read about trying to almost like do fractionalized payments and put things into kind of daily transactions. So, you know, linked to kind of gig economy workers and being able to kind of pay. Almost like pay people every day, kind of small things. It feels a long way off and a very kind of speculative kind of step to do, but the barriers in terms of payment infrastructure aren't there anymore. And actually, you could kind of move towards models where smaller amounts of money move around from B2B players. There's also some work that's already been done in the payment space around kind of products like RTP. So these are, I suppose, aimed at consumer end, essentially B2B as well. So Pay.UK have been running, I think, for about 18 months on a framework referred to as RTP, so request to pay, and essentially that's letting people who kind of work on that infrastructure to raise invoices to have part and full settlement against those invoices a lot quicker. There's some speculation that will replace things like direct debit, where you don't have an awful lot of control of when money leaves your account. So again, looking a little bit more into people with less steady cash flow and being able to make payments when you're ready, but have them connected directly to the business that needs to be paid. Yeah, I've not seen many examples of that in practice so far, but I know there's people kind of working on it and products.
David, can I just jump in there? Because that model, actually, there are lots of companies doing that already, and it's actually something that is one of the most beneficial answers. So the request to pay service is the Pay.UK one actually is in my opinion, completely flawed, because it requires both the seller and the buyer to be registered, which causes a major amount of friction. If a payer is required to register for something instead of just being able to pay for it, then you're causing a major amount of problems, particularly as it's only open to bank transfers. And as we know, 50% of all payments in the UK are now paid by debit card, and that has increased since we've moved from what people are describing as contactless payments to contact-free payments because of COVID. So request to pay services are really, really critical, and that's because the smaller businesses that I described earlier, they often are on their own. They're often sole traders or people with no finance department or no admin department. And so, Katie, to your point about technology, absolutely technology has got a role to play here. I'm not going to talk about what we're doing at Bankify because I don't want that to turn into a sales pitch, but frankly, there are solutions out there already, and a number of the traditional banks are working on those solutions with Pay.uk or without Pay.uk. And you can do things like automate reminders to people who should have paid you, as David quite rightly says. You can do partial payments, you can do future dated payments, you can do the replacement of direct debits by standing orders, which reduces the fees around direct debits, which is an incredibly expensive instrument to pay for anything. It's just that culturally we in the UK have been used to doing that because there's nothing that's been out there that's perceived as being better. So there's loads of things that can be done without legislation. It's just the community, businesses as a whole, need to stand up and take responsibility for paying their customers, paying their suppliers. And technology can play a major, major role in that. And the last thing I'd say on that point is that we as a country have been used to paying everything by cards. The cards model for a small business is an absolute rip-off. People that get paid by PayPal or Stripe or others, where those organizations are taking 3 or 4% of the value of the transaction, holding on to the money, hiding behind the risk and compliance scenario, when in actual fact they're just sitting on lots of money that should be given to the seller immediately. And that's what request to pay can do. It takes out the middleman. It allows money to go straight into the seller's bank account immediately at a fraction of the cost. And so there's loads of things that can be done around that collection issue and the debt problem that could become enormous.
Which country do you think is doing better than us in terms of modernising the way that they do this stuff and their culture around late payments?
Actually, you know what, the UK, in terms of technology and regulatory environment, is a pioneer. We are seen as world leading in the fact that we have a regulator that is very forward thinking and is making things happen and is actually paving the way for technology and other institutions other than banks to solve these problems. In terms of the late payments problem, unfortunately, we're right down near the bottom. I think Australia is the only country that has a worse problem than we do in the developed economies. Ireland, for example, has they have a positive payment. Their suppliers are paid before due date often. So I think it is a combination of government, local government, responsible business and community coming together to solve the problem. But we can't wait for the regulator and the government to legislate to make this problem go away. We have to, collectively as an industry, take responsibility. So I would say Ireland is probably the poster child, where they, I think, on average pay 5 days early as opposed to 71 days late like we do.
Wow. Alison, do you want to come in on any of the points that Mark's raised?
Not at this moment in time, sorry. So payments isn't really my subject matter expertise.
No, that's fine. I just thought if you wanted to comment, then you could. But I think we've kind of also highlighted the fact that these 5 million micro businesses are going to have kind of really, really difficult times, and hopefully maybe we'll talk about that in a bit more detail at the next Fintech Forum. But moving on, we've seen quite a lot of stories in the press about some of the big kind of, and to use your word, Mark, the poster child of fintech declaring losses, making some redundancies. How do you think some of this will impact on consumer faith going forwards, and people kind of leaving their traditional banks behind to go and kind of use some of these challenger banks and new services? So I'm happy for anyone to come in on that.
I'll take a stab at that. I actually think what you're seeing is the inevitable consequence of something that had become incredibly fashionable. And actually, when you look at the underlying business models of some of these organisations, they were flawed in the first place. So if you take Monzo, for example, banks make money from lending. They make money from net income, which is the arbitrage between deposits and lending money out, and that's how they make money. Monzo doesn't have a loan book, so it might be a fantastic experience, and the pink salmon-coloured debit card is really cool and trendy, and it tells you all sorts of cool things in your digital experience, but they don't make any money. So that it was inevitable that they were going to have to do what they do. Starling, on the other hand, someone described the difference between Monzo and Starling to me as Starling is a great bank and Monzo is a great brand. Starling have a fantastic digital experience, and they're a proper bank. They do. They have a substantial loan book. They've raised lots of capital, and they're doing the right things. And then in terms of some of the other fintechs, COVID has kind of accelerated what was always going to happen in the fintech world, right? You've seen this massive plethora of companies. It's a bit like the dot-com bubble in many respects. You saw all of these crazy, wacky things coming out there, and billions of venture capital being raised on what are ostensibly bets. And, COVID has just probably brought around a rebalancing where some of these organizations that don't have a business model, that don't really have a problem to solve, they're a technology looking for a problem to solve in many respects. And so a lot of them will disappear. And that's just almost natural selection. So I think, some of the challenges that face the fintech community is going to be around whether or not they have a viable solution that actually has a problem to solve. And those that do will survive, and those that don't won't. And the likelihood of the Monzos of this world, being snapped up by other traditional banks because they've got a much better technology infrastructure, is possibly a way some of these things will go as well. So you're going to see, I think, over the next 2 to 5 years, you're going to see a reduction in the number of fintechs, and you're going to see probably more a balance of the traditional banks coming back. And let's face it, even with the fintech revolution, all the research says that people still trust their traditional bank more than they do a fintech or a big tech. When asked whether or not you want to put your money inside Google or Apple or Facebook or HSBC, Barclays or Nationwide Building Society, it's a resounding the latter rather than the former. So I don't think trust is going to be eroded in fintechs because of COVID. I think trust in fintechs was already there. There was a lot of skepticism about them anyway.
Okay. Alice. Oh.
And I was actually going to add to that. Yes. So trust is actually something that we have in spades, I'd like to think, in Handelsbanken with our customers. We are a very different model, and that's the thing. Culturally, we're very different. We don't do bonuses. So there's no aggressive sales targets or marketing or anything like that. We're not even present on the high street, so you wouldn't even see the Handelsbanken logo on the high street. So culturally, we are very different, and I think our customers trust us because of that. We're also a customer experience bank, and I think there's a reason why the customer experience is probably one of the fastest growing disciplines, because, there hasn't always been the trust, between the financial institution and the customer. And I think we've still got some way to go to build that back since the financial crisis. And we're going into another economic crisis. So I think trust is going to be really, really important. But also other things like fixing things when they go wrong, and also making sure that we deliver on our promise. When we say we're going to deliver something, we actually deliver it. We really know our customers. We know what makes them tick. We know what their financial needs are. And also we make things easy for them. And I think this is where some of the newer startups and some of these new fintech organizations are doing really well, where us traditional banks probably need to catch up. I don't think Handelsbanken would mind me saying that we are probably a little bit behind the curve when it comes to our digital propositions. So we have got some way to go there. But yes, I think customer experience is something we're really good at, and we're very humbled by the relationships we maintain with our customers, and they do tend to trust us. And we are a challenger bank at the end of the day. We are a challenger bank, although we do operate slightly more traditionally than Bankify, for example.
Okay.
I think I've got like 4 angles on this, so I'm going to try and come in with all 4 of them. I think the first one that I'll come in at is the consumer side. So with headlines and kind of columns has been taken up about kind of negative, no profit being made, and job losses in various kind of large fintech providers. I think it causes consumer distrust, I guess, and the question there is whether people really understand things like the FSCS scheme and how safe their money is and that it's protected, and whether we're kind of collectively good enough at telling that story about those protections and how they work. There are some nuances in there that are worth consumers being aware of, and they need to kind of told that story. I think the second angle that I take on it is what happens on the back of some of the job losses and right sizing that fintechs are taking at the minute, so in particular where they're losing staff or losing 25%, 20% of their kind of staff. A lot of the time, the reason they're doing that is it's the innovation angle. It's the more speculative pieces of work that they might have running that are being stopped, which I think is a shame, because again, those types of programs are the incubators for the things that come next. So yeah, that's second angle. The third one I think would be around opportunity in fintech. So kind of leading on what Mark was saying there as well, that a lot of the certainly a kind of speculative approach would be that fintech is good at solving problems, and a lot of problems are new right now this year. So having fintech providers being able to answer some of the changes in consumer behavior, the barriers that people are facing, really kind of positions a good opportunity for growth in that sector. I think the last angle, the fourth one, is around the investment profile for fintech. So investment is definitely down. It's down a lot, and if you kind of take a closer lens on that, where investment is happening in fintech sector, it's happening less in the startup areas and more in the kind of established growth areas as well. So the providers that are in their kind of growth cycles. I guess speculatively, again, you'd assume that what will happen over the forthcoming, 12 months or so, is that with kind of weaker balance sheets and more kind of business problems to solve in those fintechs, that we'll see more merger and acquisition activity. So be that through traditional banks acquiring fintechs and working that way, or actually, and again, just linking a little bit off what Mark said there, potentially some of the larger tech providers, the kind of Googles and Facebooks and everybody else who's taking steps into sometimes significant steps into financial services, and how they might further grow that book, since they potentially have the cash to acquire kind of good businesses. And
just to finalise on that, Casey, I think there's a really interesting thing that probably sneaked through the press this morning that is really, really important in what David just said. Is the we in the UK have had this luxury that retail banking, consumer banking is free, and I can assure you, retail banking and banking in general is anything but free. And so we, the consumer, have been led to believe that we should get it for free, when in actual fact it's an enormously costly thing to be a bank. And HSBC this morning, it came through in the Financial Times, they're going to start charging for current accounts. And once the traditional banks start charging for current accounts, which a number of them already do, that's going to put a massive amount of pressure on fintechs who don't have a loan book. Because how do you make money? Right. So you're going to have to start being a proper bank at some stage, and that lends itself to all of the things that we probably as consumers get very frustrated by. Why are our banks slow? Why do they not offer the same services as a Revolut or a TransferWise or all these others? And that's because those parties do the things around the edges. They do all the things that fintechs can chip away at. But when it comes to running a bank and making sure that our money is safe and protected and is covered by the compensation scheme, that requires an awful lot of capital to be able to make sure it's robust and tight. So I think what you're going to see is, in many respects, purely a personal view, that traditional banks will become a safe haven, because unlike the financial crisis, where they were all heavily undercapitalized, they're massively well capitalized now. They've got very strong balance sheets, unlike a lot of fintechs.
Yeah. Free banking's a bubble as well, isn't it? So as soon as one person pops that bubble, the rest of the high street and all the providers can follow.
You're right.
So we have a question on that point from Rachel Carney. Who's interested in how this will take traction with HSBC. So basically, your point: what are the other banks going to do now HSBC have come out and made that bold statement? What do you think, they'll lose customers in the short term?
Well, I think, like David's just said, once one of them does it, it's like the mortgage rates, right? When the interest rates go, you'll see it's like a cascading domino effect where they all react to it. I mean, there are a number of parties that already charge for current accounts, that maybe not the big four, but I just think other parties will follow. In my view, I think, as I said a minute ago, it's been a gravy train to consumers. We think it should be given to us for free, but the reality is it's incredibly expensive. We don't have a problem paying our telcos or our other service providers for the service we get them. Why wouldn't we pay our banks for a service that is, they very rarely lose money. Fraud might be there, but it's pretty well managed. I think it's an unreasonable expectation to think that we'll get a very good service for free. I think all of them will.
Alice,
and just to Handelsbanken, yes. So our banking services aren't free. And what we've found is that if you offer a really good service and you're banking the right customer, then they're willing to pay for that service. And we tend to bank with customers who share our values, such as economic sustainability, environmental and social sustainability, and they stay with us. They tend to stay with us for much of their banking, for their banking life, if it were, as it were. But and so the customers are willing to pay for a good service.
Yeah.
And I think our model, in terms of the decentralization, which I know I keep banging on about, but it is something that makes us very different, because what we're able to do is offer unique products and services for that customer's needs, and that doesn't happen in many other banks.
Yeah.
So Alison, Rachel's asking, are your customers high value?
They a lot of, for the large part, yes, but we do have quite a plethora of different types of customers. It's not just about the economic sustainability, that's part of it, but it's about banking with customers who also share other values such as social responsibility and environmental responsibility as well. So, but I would say the large part, yes.
Yeah. It kind of leads on to, you know, so if free banking goes, then it puts more pressure onto inclusivity of banking services, doesn't it? There are 1.2 million people in the UK that don't have a bank account currently.
Yeah.
How do they get one if there's barriers to entry? You know, even if it's a few pounds a month, that might be significant. And you know, who caters for those people?
Well, and it also moves into the types of services that they offer. So one of a very poignant scenario could be that, you know, cash and checks, which are incredibly expensive for banks to handle, are they going to move towards a scenario which is, you know, a complete cashless society, and certainly eradicating checks? You know, we as an industry spent billions on imaging checks recently, just so that you could image your check inside mobile banking applications. You know, the instrument is on the decline. It has been for years. It's an incredibly expensive instrument, and you know, why should banks continue to offer a service that the vast majority of customers don't want to use and don't use? You know, and as I say, we as a country and an industry have spent ludicrous amounts of money on something that we could have spent much more sensibly on.
So who do you think will step up and make provision for those underbanked people and the people that can't afford to pay?
Non-shareholder banks, building societies, credit unions, cooperative banks, those types of organisations. I mean, they do it already. You know, I think we have to look at the ownership structure of banks and what their modus operandi is. And I think we already see who the parties are that will step up to the plate, because they have it built in their ethical stances. So I think building societies and credit unions and other community-led organisations, it could be very refreshing. You could see, you know, a throwback to, you know, in the 21st century, a digital scenario of your local branch and your local branch manager all being done through, you know, the community and you know, that being digitized rather than face to face. And digitized doesn't necessarily mean, you know, a non-human interaction. It might be through video and other things. But yeah, I think those parties will step up to the plate. The traditional shareholder banks will always be about maximizing profit.
There's a catch-22, isn't there, somewhere with inclusivity and you know, charging for bank accounts, especially if you're kind of sensible about that and you recoup your costs of the most expensive transactions types, so cash, check, you know, potentially kind of branch usage and stuff. But that's if you did it that way, and the most expensive mechanisms are probably, or you know, in fact they are the ones that are relied upon by the most vulnerable people across kind of society as well. So particularly kind of cash usage, people on low incomes, for example, using cash to budget better than electronic payments, that kind of thing. So.
You're right, and there are some things that that the banking community can do. So, for example, it'd be interesting to see what your audience think. That, you know, another thing that we spent a ludicrous amount of cash on, including TV advertising campaigns, was the Incentivized switching scheme.
Yeah.
You know, 93% of people do not switch. And you know, your sort code and account number that you all have is tied to bricks and mortar branch. All your payment systems are tied to bricks and mortar branches that you know, vast majorities of people don't use anymore. Every single bank has a core banking system, which is the same as everybody else's core banking system, and it costs them billions a year to run. Why wouldn't we have a shared infrastructure around a sort code and account number and a payment system that didn't require all of the banks to have one of their own? And that's a way that we could cut out a lot of costs in the banking system, which would reduce the fees that would need to be charged to run a current account. Because let's face it, the current account fee would be tied to the cost of running your current account infrastructure. And if that was shared across all the banks, because you say, let's face it, one sort code and account number, whether it's at Barclays, is the same as the one at HSBC, is the same as the one at Starling, is the same as the one at the next one. So why have we got something that is unique and not differentiated and a commodity? Why don't we just build a shared infrastructure? And that requires banks to think actually what the customer needs and how they want it is all about the services around it, not the actual product itself.
Yeah.
Alison, have you got some views on that?
Yeah, so I mean, we suffer from the same issue. Legacy platforms. Our core banking system is written in very old language, COBOL, and even the developers are, for want of a better phrase, they're a dying breed, because there isn't that much skills out there in order to come and support the platform. So we are looking at replacing the platform. But it does cause us an awful lot. It costs an awful lot of money, and it causes us a lot of resource impacts to maintain it. And it's the speed of delivery to the customer which is really, really problematic for us. It takes a long time to build stuff. So I agree with Mark, what Mark is saying in terms of having some sort of shared infrastructure, if it could support faster delivery to customers and more value-driven outcomes.
Okay, we've pretty much reached our end of session now. So, just are there any final thoughts on that, David? I don't know if you've got thoughts on that shared infrastructure.
There's some advantages. I think exactly what Mark was saying about kind of service layer rather than infrastructure. I'm also aware that things like distributed ledger technology are very useful for securing that when you've got a number of people who hold the kind of keys to that infrastructure. So you potentially have the option to secure all that data and transactional layer better than you can with a single institution operating it. So there's definitely some advantages to kind of move in that way. And yeah, it's a new world as well, isn't it, technology-wise? So you would never have been able to do that 20 years ago with kind of on-prem servers and everything else. But you can kind of do that now. Yeah.
Okay.
I'm not sure I'd want to build my banking infrastructure on a distributed ledger that doesn't work.
Well, yeah.
Speaking of technologies with a problem to solve, looking for a problem to solve, I think we could have a whole session on that.
Yeah, there probably is actually. Yeah. There's some interesting ways of doing that, but I've not really seen a scale and critical infrastructure secured in that way.
Yeah.
Okay, so I'm gonna draw us to a close there, but I think every time we do one of these sessions, we seem to open up a can of worms for like the things that we can discuss for several more sessions. And I think Rachel's mentioned something about security. I think again we could do a whole session on security, and picking up on what Mark said, we are hearing a lot more about credit unions just in general in the press and other things. So I think maybe we'll do a session with some of those non-shareholder community institutions, because it would be really, really interesting to dig into that and the inclusivity piece, which comes up every time we have this conversation. So we will pencil those in for future sessions. But I would really, despite the technical problems, thank you so much to our panelists for battling through, and to all of you guys for sticking with us. I know it's not always easy. So thank you very much to Mark, Alison and David for such a varied and insightful contribution. We really appreciate it. If you look at the left of your screen, you will see an icon of people shaking hands, which is the networking. So if you would like to move across there, it's basically like a speed dating thing. You get 3 seconds to chat to a fellow attendee. So you may want to continue your discussions on fintech. You may want to discuss something entirely different. It's up to you, and hopefully it just helps you to keep some of your relationships going and build some new relationships during these socially constrained times. So that's basically it from us. We will be in touch with dates and topics for our next event. And once again, thank you to speakers and our sponsors and digital and teledata. See you very soon.